G'day mate, how you doing? Imagine this, $1,000 hitting your bank account every single month, purely from your investments, letting you pay bills, go on holiday, or just relax. Sound impossible? It's not. And today, I'm going to reveal the top 5 ASX ETFs that can make that a reality, creating your very own holy grail income portfolio. But here's the kicker, one of these looks great, but has a hidden trap that could cost you thousands. Stick around because I'll tell you which one to avoid and why by the end of this video. Welcome back to ETF Insights Australia. And if you're serious about financial freedom, you know passive income is the key. But most dividends pay quarterly or semi-annually. What if you need that cash every single month? That's where carefully selected ASX ETFs come in. We are not just looking for high yields, we are looking for consistent monthly distributions and sustainable growth. Because a high yield means nothing if the underlying asset is collapsing. Before we dive in, a quick but crucial disclaimer. This is general information, not financial advice. Always do your own research or consult a professional. Now, how did I pick these 5? I focused on 4 key criteria: monthly distribution history, consistent payouts for at least 3 years, sustainable yield, not just a high number, but one backed by quality assets, diversification, broad exposure, not single stock risk, low fees, management costs that don't eat into your returns. Kicking off our Holy Grail portfolio, we need a strong foundation. And for that, I'm starting with Nasdaq 100 ETF short form NDQ. Why NDQ? Because it comprises 100 of the largest non-financial companies listed on the Nasdaq market and includes many companies that are at the forefront of the new economy. Exposure to global tech leaders like Nvidia, Microsoft, Apple, Tesla, etc. Fund performance for the past year as of the 30th of September, 2025 is 28.96%. A solid track record of monthly distributions, averaging around 0.9% semi-annual. And a reasonable management fee of 0.48% per annum. This isn't just about income, it's about growth from high-quality companies that also happen to pay you monthly. Next up, we are bringing in some fantastic Aussie flavour with Vanguard Australian Shares High Yield ETF, simply VHY. What makes VHY shine? It focuses on higher forecast dividends relative to ASX-listed companies. Australian companies with strong dividend track records, often with the added bonus of franking credits. The top holdings are BHP Group Limited, Commonwealth Bank of Australia, NAB, Westpac, Telstra, Rio Tinto, etc. Its yield is typically higher than global funds, sitting around 4.41%, and crucially, it pays every month. It's a great way to balance your Australian exposure with solid local income. To truly make this a holy grail portfolio, we need stability, especially in volatile markets. That's why ETF number 3 is Vanguard Australian Fixed Interest Index ETF, simply VAF. Why include VAF? It invests in Australian government-related, and corporate issuers, which are generally less volatile than equities. It provides a consistent income stream, acting as a defensive cushion for your portfolio. Low management fee of 0.1% per annum. Now for a bit more horsepower in our income engine. ETF number 4 brings in a higher yield from global sources. Australian Top 20 Equities Yield Maximizer Complex ETF, called as YMAX. What makes YMAX powerful? It seeks to generate enhanced income through strategies like financials, materials, consumer discretionary, healthcare, etc. Its target yield is often significantly higher, around 9%, providing a chunky monthly distribution. Crucially, it broadens your income sources beyond just Australia, adding another layer of diversification. Okay, we've covered 4 fantastic monthly income ETFs. But remember what I said about the hidden trap? This 5th ETF is popular for its high yield, but there's a reason I would avoid it for your core income portfolio. And that ETF is a highly leveraged fund like TQQQ. On paper, a highly leveraged fund looks incredible, with a reported yield of 29.83%. But here's the problem. A significant portion of its distributions often come from returning your own capital, not genuine earnings. This means your initial investment slowly shrinks. It often comes with extremely high management fees, sometimes over 0.82%, eating away at any gains. Or it's concentrated in a niche, volatile sector, exposing you to far too much risk for a core income strategy. My advice? Stick to proven, diversified funds with sustainable distributions. A high yield means nothing if you're losing money on your principal. So, how do you put these four Holy Grail ETFs together? Here's a hypothetical example of how you could allocate a $100,000 portfolio to generate robust monthly income. Let's say NDQ, 30%, $30,000, growth and monthly income. VHY, 25%, $25,000, Aussie high yield and franking. VAF, 20%, $20,000, stability and defensive income. YMAX, 25%, $25,000, enhanced global income. This mix aims for diversification, monthly payouts, and a balance of growth and stability. You can adjust these percentages based on your risk tolerance and income goals. To recap, building a monthly passive income portfolio with ASX ETFs is absolutely achievable. Focus on sustainability, diversification, and consistent payouts. And remember that one ETF we discussed? Always look beyond the headline yield. Which of these ETFs are you considering? Or do you have another monthly pair you swear by? Let me know in the comments below. If you found this video valuable, please smash that like button, subscribe to ETF Insights Australia for more in-depth analysis, and hit the notification bell so you don't miss our next video. Thanks for watching, and I'll see you next time.